Monday the 6th. Let's go over the trade alerts and talk about a very important topic, evaluating risk. So, first of all, as far as my account, I did not take any trade alerts today. I am still having an issue with the license, with my auto trader license. I was not able to activate it, and I was way too busy today with other charts to trade the trade alerts, but I do want to go over them and then, while looking at them, talk about evaluating if a trade is worth the risk and what is your risk tolerance when you are considering participating in a trade. So the Nasdaq was a short at 12,558, and it triggered a number of times during the day today. It's a very common phenomenon that the trade alerts, those prices, are triggered more than just once. In vast majority of cases, they are triggered more than just once within a session. The S&P was a short at 41.29, and again triggered a number of times in the session. Now I recommend to the group members to simply grab your $100. Not because more is not available. Most of the time, quite a bit more is available, but it's only the more advanced traders that would know how to keep a position, how to manage, let's say, a position beyond just the nominal amount of 100. Oil was a long at 74.21, so it triggered earlier this morning. Now, in this case, in the case of oil, they did not give you much more than 100. So the long at 74.21, the high is right about 41. So about $200 per contract was the most that was available. So in this case, going for the 100. I think definitely made sense. The Dow was a short at 33,790, triggered earlier today, right after the U.S. session open. 20 ticks in the Dow is what we are looking for to get our 100. They give you more than 20 ticks, as they often do. But again, I would just recommend the 20 ticks. The Russell was a short at 1979. So again, right after the pit session open, we're looking 20 ticks on the Russell. Once again, they gave you quite a bit more. The point is, when this trigger happens, you don't know how far they're going to go. So I recommend the 100. Again, the more advanced traders can definitely squeeze more out of it. Gold was a long at 1887. And once again, in gold, just like in oil, they gave you your 100 for sure, but the high here is 88.8. So even less than 200 available in gold. So, if you grabbed your 100, you were happy. And if not, you would definitely have gotten stopped out. Also, for the first time today, because a number of members that we have are from Europe and they trade the 6E. So I tried the 6E for the first time. So let's take a look at that. So the euro was a short at 1.08020 and definitely worked out nicely. Again, same exact concept. The trigger price is triggered a number of times in the session because these numbers are important to the market. Myself, I do not trade, or I don't think I've ever traded the euro. Really came down quite a bit from that trigger. But, some people requested it, and I just said, fine, I'm going to try and give it a shot. So for today, the euro worked out well. Okay, now let's get to the topic of this video, evaluating risk. All right, so let's say there was a trigger coming up. In this case, it's the Dow. I thought the Dow was a bit tricky today, which is why I picked it for this discussion. So the short at 790, 33,790. So you see price coming down after the session opens towards 790 and it triggers 790. Now, you could have either a hard stop or what I prefer, a pivot stop. Now, if you're going by the pivot and you see price entering the trigger, should you just take a short simply because the price triggers? Well, if you are going by the pivot stop, this pivot is all the way up here above 900. So your stop is like $550 or so. Does that make sense? I think most of you would say no, does not make sense. So what you do is make it a bit larger maybe. Okay? You don't have to take this trade. Just because it triggered does not mean that you have to participate in the trade. Sorry, I had to take a phone call. So where was I? All right, yeah, so a trade triggers, right? I mean, an alert triggers does not mean you have to trade it because the risk is just too much. There's no reason to take a trade just because it might be a qualified trade. Well, price goes below. Not sure if it gives you your 20 ticks. Probably not. I don't think it gives you a 20 ticks. And then comes up. Okay. Now price comes down and triggers again. Well, now the risk is a bit less, right around like 880 or so, but still probably too much. Would not take this trade. So again, you are not taking the trade. You're sitting back. You are patient. You are waiting for the right kind of opportunity. Don't take a trade just because it might be a qualified trade. You need to, and that's where experience comes in. First of all, you know, and members know that see this trade alerts all the time. Price will trigger more than once. So there is no reason to hurry. If you're missing a trade, you're missing a trade. It's okay. You will probably get another chance. So what happens next is again, price goes below the trigger, comes up, and triggers again. Now this time, the stop is around 50 ticks, so about $250 over here. So again, you ask yourself, am I willing to risk $250? If the answer is no, you don't take the trade. Price goes down, comes up, and when it comes up, it makes this tiny little pivot over here. Hope you can see this wick over here. Now the risk is about $60. Price breaks and makes a low of 67. Enough for you to get your 20 ticks. $100 for the daily goal. If you did not take the 100, then you would have gotten stopped out with between $60 and maybe $80 loss. Let's look at another one, the Russell, right? So again, after the session opens, the Russell comes up, makes this very high pivot before hitting the trigger short. So are you going to take this trade? Probably not. Way too much risk. That's fine. You wait. Again, let's enlarge the chart a little. Price goes down, so you missed a winning trade. This would have given you 20 ticks, but that's okay. This was not the right trade for you because the risk was just too much. Price comes back up again to the trigger, as it does every single day. Makes a pivot before breaking down again. Now this pivot is only around $200, a bit less than $200. So this might be a much more reasonable risk for you. Let's say it's not, or you miss the trade for whatever reason. Price comes down, price comes up. Makes pretty much an equal high here, equal pivot, and goes down. If somehow you missed all this, or the risk is still too much for you, look what happens a bit later on. Price comes up. And again, just like we saw with the Dow, this tiny little pivot, very small amount of risk. And on this move, you can definitely get your 100. Now, am I saying that in every single case, in every single instrument that I post, you're going to have an opportunity to have the perfect risk amount for you? No, I have no control, nor does anyone have any control over what the market is going to do. All we can do is we can make our decision. Is the risk too much? And if the answer is yes, you do not take the trade. Trade on your terms, not on the market's terms. Let's look at the NASDAQ. So the NASDAQ was a short at 558. Again, a number of opportunities to go short, but let's look a closer look at what happened. Now, with the NASDAQ, unlike the Dow or the Russell, the first attempt at the trigger short again here at 558 immediately resulted in a tiny little pivot. I mean, really, this is very small risk, something like 11 points for the NASDAQ is nothing, and then easily give you your 5 points or more, depending what you were looking for. If you missed this one, here was another one. You missed this one, here was another one. Now, when price comes up again and breaks through, now this pivot is too high. And again, just because a trade qualifies does not mean you have to take it. Besides the fact that if you got your 100 for the day, which is part of my approach to the group, you have your 100, you're done. If for whatever reason you missed everything, this pivot, I think, is just too high. So is the trade a qualified trade? Yes, it is. But the risk is too much. So if the risk is too much, I'm not going to take it. Yes, ended up being an amazing trade. But that's okay. I missed it because the risk was too much for me to take. What does price do? Comes back up to the trigger again. And look again at this tiny little pivot. Easy 5 points plus. Same here. Easy 5 points plus. Then goes up substantially. And here it comes down to the trigger. But this pivot is again way too high. Is this a qualified trade? Sure. But the risk is too high. I'm not taking it. Ended up being a great trade. That's okay. I missed it because my criteria for risk was not met. Price comes up, again makes a small pivot, and breaks down. So I hope this helps. If you have questions, email me or leave a comment in the video. What I'm trying to get at is, yes, the alerts are profitable every day. These numbers that I am posting every evening to be traded the following day, every day they produce profit. But just because you see a trade that gets triggered, I mean, an instrument that gets triggered, it does not mean that that particular trade is right for you. You must use your own judgment based on, by the way, your trading plan. That's where trading plan comes in and why trading plans are so important. Okay, guys, that's it for today.